Hey traders, Gavin here from Options Trading IQ, and today I'm going to show you how to trade your very first iron condor. I'll explain what they are, when to use them, how to set your strike prices, what expiration date to choose, and what width to use for the strikes as well. So let's get started. Just a quick reminder, everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So first things first, what is an iron condor? Well, it's a neutral income trade made up of two credit spreads. You sell a put spread below the market and a call spread above the market. You take in a credit, and that's your max profit. Your risk is capped at the width of the spreads minus the credit. That's why traders love it. It's defined risk and steady theta. Iron condors work best when you expect the underlying to stay range bound. They're especially effective when implied volatility stays subdued. When you're starting out, you probably want to stick with liquid names like SPY, QQQ, or large cap stocks. Generally, you're looking for something with really good liquidity. One of my filters is minimum 5,000 daily option volume. And try and avoid trading them into big events like earnings, Fed announcements, or big economic data releases. In terms of the expiration date, a really good starting point is 30 to 45 days to expiration. Anything under 30 days is probably a little bit too short term. They can move really, really quickly, particularly weekly options. If you're doing a weekly condor, you've got a lot of gamma risk. Basically, that just means you might see big changes in your P&L, even if there's only a small change in the underlying stock price. So try to avoid really short-term options, and then really long-term options are going to move really, really slowly, and they're not going to generate much theta. So a really good sweet spot is that 30 to 45 days to expiration, and try to stick with the main monthly expirations rather than using the weekly expirations. This means time decay is working in your favor, but avoids extreme gamma risk that shows up in the last few days. In terms of selecting strikes, you've got two main ways to choose them. So the first one is from the delta, and a really good starting point, again, aim for the short strikes around a 15 delta. That's going to give you a roughly 15% chance that that strike will end up in the money. So roughly an 85% chance that it will expire worthless. So it gives you a really high probability of success. The other way is by using support and resistance. So try and place your short calls above some resistance levels and your short puts below support levels. And if you can tie that in with that 15 delta as well, that's perfect. In terms of wing width, try to pick a consistent width. And again, a great rule of thumb is 5 to 10 points wide on ETFs like SPY. Microsoft, Apple, Nvidia, 5 points wide is going to be perfect and a really great starting point. The wider the spread, the bigger the margin requirement, but also the bigger credit you can collect. And we'll look at some examples. So here we've got an example using Apple. We're setting our short put at around the 15 delta and our short call at around the 15 delta, and we're going 5 points wide on each. You can see overall we've got basically neutral delta. We've got a delta of -1, that's effectively neutral. And this is our profit and loss graph. So we've got about $100 to $110 in premium that we're receiving. We can tell that from the expiration payoff graph. And our maximum risk is about $390. So that's our blue line, shows us our profit and loss at expiration. The purple line shows us what's called our T plus 0 line. And this is basically our trade date plus 0 days. It shows us how is the trade going to perform today. You can see if the stock makes a big move, we're going to start to move into a loss situation on the downside and the upside. If I change that to be the end of the month, we can see this is how the trade is going to look roughly on October 31st. So we definitely want the stock to stay relatively neutral in between about, say, 245 and 265 over the next 2 or 3 weeks. If we go with a wider spread, and now we're going with $10 wide on the puts and $10 wide on the calls, we're still keeping our short strike the same. We can see we've got a different looking trade. Here we're generating about $175, $180 in premium, but we've got more risk in the trade now because the spread is wider. So one contract, $10 wide, it's basically 1,000 of risk less the premium received. So 1,000 minus the 175 is about 825 of risk. When you're starting out, you probably want to keep your wing width fairly narrow to make sure you're not risking too much, just so you can get a hang of the trades and how they perform. In terms of order entry, you can either enter it as a single order or as 2 credit spreads. I generally prefer to enter them as 2 separate credit spreads, but you can do it as one trade, and I'll show you both methods using interactive brokers. You also want to make sure you're using limit orders and that you're near the mid price. Avoid market orders because slippage will eat into your edge. And slippage just means basically not getting filled quite at the midpoint, and you can be a little bit behind the 8 ball right at the start of the trade, which you don't want. So within interactive brokers, there's a couple of different ways we can do the order. We'll go to combinations and option combos. We'll change our strategy to vertical spread. We're going to do the 2 credit spreads first. Our expiration date was November. The put options were 230 and 225. Select add, and then we'll add the calls, which were at 280. Now you might notice that the buy strike is the 280 strike and the sell strike is the 285. We have to kind of set it up a little bit backwards in interactive brokers, but we basically set up a generic call spread and then we sell that call spread. All right, so now we've got our 2 call spreads and we've got our options as well here. What we want to do is we want to look at the midpoint of this spread. And 174 minus 121, the midpoint's about 53 cents on the calls. So we come up here to the call entry. We want to sell that credit spread and we want to get a minimum of 53. So I'm going to put a limit order of 55. I want to try and get that filled. Then on the puts, we've got 193 minus 141. And that is also about 52 cents. So we can come in here on our put spread. We'll click the bid price to create our sell order. Good till cancelled. And we could do the exact midpoint of 52, or we could do 55 and just leave them sitting there. Once one gets filled, we want to then update the price on the other one to make sure that gets filled pretty quickly as well. The other way to do it would be as a single iron condor order, which some people may find this a little bit more confusing. We go into our combo again. Here we're going to choose iron condor, choose our expiration date. The lower wing, we're going to start with the 225. The middle put, or the put that we're selling, is 230. And then the call that we're selling is the 280. We don't have to put in the upper strike call because it knows that this is $5 wide, so it knows we're going to put the calls as $5 wide as well. We'll add an OK. And we've got our little cheat sheet here. We always want to just double check this. We want to make sure we're buying the iron condor because we want to sell the middle strikes, the 230 put and the 280 call. So we want to make sure we're buying the iron condor. Now, this is where it gets a little bit confusing because we have to put in our buy order. We'll do good till cancel. But because it's a credit trade, and this is why I don't like using this order, I prefer doing 2 credit spreads. We know that we're selling these 2 for about 55, so the combined amount is $1.10, but we don't want to buy it for $1.10. We want to actually receive a credit. So we actually have to buy it for a negative price, which I think is a little bit more confusing than doing it this way. But again, some people may prefer doing this type of order entry. With other brokers, it might be a little bit simpler. Interactive brokers can be a little bit clunky when it comes to credit spreads and condors, but basically this is how you do it. Either 2 credit spreads as a sell order or a single iron condor entry as a buy order with a negative price. Effectively, these 2 orders are going to be the same as this. We're both going to get $1.10 in credit received. In terms of risk management, position sizing is crucial, particularly when you're starting out. Never risk more than 1 to 2% of your account on any one iron condor trade. As you get more experience, you can start to size up a little bit, but when you're first starting out, 1 to 2%, again, really good rule of thumb. Use the max loss number to size correctly. So we were risking about $400 on that condor, so make sure that's not more than 1 to 2% of your account size. If the max loss is $400 and you're risking 1% on a $50,000 account, 1 contract is about the right size. You could potentially go to 2 contracts as well if you wanted to get up to that 2% risk. The last point here, and this is absolutely crucial, if you only remember one thing from this video, make sure it's this. Never let the stock go past the short strikes. It gets much harder to salvage the trade when that happens. So we always want to adjust or close the trade before the stock breaks through the short strikes. Going back to our Apple example, what I like to do is I set a price alert halfway between the current stock price and the short strike. I can calculate that out, or I can just eyeball it. I know it's going to be about here, about 242. So I set a price alert on the downside at 242 and on the upside at about 266, 265. If those alerts get taken out and those alerts go off, I know I need to either adjust or close the trade. If they don't go off, I know the trade's more or less okay because I'm sitting in this range here. And I have a little analogy with this T plus 0 line is I imagine this T plus 0 line, it looks a little bit like a hill, doesn't it? And I imagine the current price of the stock is a ball, and that ball's sitting on top of the hill. As long as the ball's on top of the hill, it's not really rolling, that's fine. If the stock starts to drop, that ball starts to roll down the hill and we get to about here around where our price alert is, that ball's going to pick up speed and it's going to start rolling quicker and quicker, and our losses are going to get bigger and bigger. So I want to set my price alert here at 242 before that ball rolls too far down the hill, and I want to take some action there, either hedge, adjust, or close. And I've got lots of videos on adjusting condors and credit spreads and things like that if you want to check them out. So once again, never let the stock go through the short strike. In terms of profit targets, a lot of traders will take profits when 50 to 75% of the credit has been captured. So in our Apple example, that first one, 5 points wide, we generated about $100, $110. If we've made a profit of about $50 to $60 per spread or per contract, that's a good time to take the profit. As another example, let's say we collected $1.50. You might close that trade out if you've got a profit of 75 cents to $1. Exiting early reduces risk and avoids painful gamma in the last week. And also consider exiting or rolling at around 10 to 14 DTE, days to expiry. So again, we don't want to take that trade too close to expiration because we get a lot of gamma risk, a lot of price risk, and that's when big losses can occur if the trade moves against you. So consider taking a smaller profit target around that 10 to 14 day to expiration timeframe, or rolling out to the next month. For adjustments, if one side is threatened, you have a couple of choices. You could roll the challenge side to cut the risk. You could roll the unchallenged side. You can roll out in time. So there's lots of different things that you can do. You want to avoid over adjusting. Sometimes the best decision is to simply take the loss and move on, but each situation is going to be different. You have to evaluate what the chart's doing, what your opinion on the stock is, and how the trade looks. Adjusting really requires its own video, as there's lots of nuances. I'll link some videos in the description below that you might like to check out. Some common mistakes you want to avoid. So don't use illiquid underlyings. That's going to really cause a lot of slippage. You're not going to be able to get filled at the midpoint, and even at the trade initiation, you're already going to be sitting on a loss. So you don't want to do that. Don't size too big. So particularly when you're starting out, just start with one contract, practice until you've done 10, 15 trades, and then you can start to build up your position size. Don't hold through earnings. We can see some really big moves. I've had many examples where I've had a condor and the stock's moved 20, 30% on earnings, and it's just absolutely brutal. So I definitely don't do that anymore. And I really recommend that you don't trade these over earnings. And remember, iron condors are not set and forget. You need rules for profit taking and defense. And it's quite rare that you'll put on an iron condor and it won't need adjusting and you'll just take the profit. Most trades are going to need maybe one, sometimes two adjustments. All right, so iron condors give you defined risk, consistent theta decay, and a neutral income strategy. So they work great in a choppy market where we're just kind of grinding up and down. They don't work well in a trending market where we're strongly trending up or strongly trending down. Really important to pick highly liquid underlyings, set your strikes carefully, manage risk, and you'll have a really good starting framework. If you've got any questions at all, by the way, just reach out, info@optionstradingiq, or you can reach me on social media. Now, adjustments take practice, so have a plan for how you're going to defend the trade and keep your position size small until you've really got the hang of those adjustments. Again, I've got a few videos on that I'll link below, and I've got some courses and things that I run that go into adjustments in much more detail. Thanks for watching. If you found the video helpful, don't forget to like, subscribe, and share your thoughts in the comments below. Reach out anytime with questions, and have a great day.